Hello, today we're going to discuss what I've learned from 11 months of investing on Robinhood. So, didn't really know much about stocks or investing, but I did know that stocks are tiny pieces of the company that can be bought or sold. The price of the stock is determined by the current success of the company, and it is best to buy a stock at a low price and sell at a high price. I knew that was how people make money in the stock market. Now, here's what I learned to help me make better investments and basically pick and choose what I wanted to do, prioritize investing. So, a number that I thought was really important to look at when it came to stocks was the dividend yield. Okay, so the dividend yield is a ratio expressed as a percentage that compares a company's annual dividend, so the total dividends a company paid during the most recent fiscal year, to its share price. So when you open up a stock on Robinhood, on the right, I just opened up Apple. That dividend yield of Apple is 0.57. So really, dividends are paid by companies as like incentive, like, hey, we'll give you a dividend if you invest in us, as opposed to companies that don't. So it's just further incentive for an investor to want to invest. And I really like stocks that pay dividends because, one, you get a return on your investment quicker, and two, the dividend yield percentage that you earn is going to be higher than whatever percentage it would be from just a typical savings account. So I think dividend stocks are really useful in this sense. Another number that I consider a lot when I'm investing, and a number that I learned about, was the PE ratio. So that stands for the price to earnings ratio, which measures how expensive the stock is by comparing its stock price to its earnings per share. So basically, the higher the PE ratio is, the more expensive per share of stock it is. So as it says here, PE ratios give investors a measure of how expensive the stock is for each dollar of profitability. In the example below, high PE ratios are a signal that investors expect higher future earnings. As of June 2019, Netflix had a PE ratio over 100, meaning investors are willing to pay $100 for each dollar of profitability. That's over 5 times more expensive than the rest of the market, as measured by the S&P 500, indicating that investors expect Netflix's earnings to grow. So it's an indicator that there could be high profitability in the future or high value, but basically you can use the PE ratio to judge how expensive a stock is. And that can indicate to you when to invest or when not to invest. Now, dividend stocks versus growth stocks, as I've discussed before, dividend stocks pay some kind of dividend to its investors, and growth stocks are basically stocks that do not pay the dividend at all. Now, the thing though is that because dividend stocks are paying off dividends to investors, they're going to generally have more gradual and slower growth. And then since growth stocks don't have to pay dividends, they generally have greater and faster growth. That makes sense, right? Because they're not paying off money to investors, they can use that money to do other things for them. And then another thing I learned is what an ETF is, which is an exchange traded fund. So an exchange traded fund or ETF tracks multiple stocks or other securities to let you invest in a sector, industry, or even region. Through an ETF, you can also track the index so you don't have to pick individual stocks. I like investing in these because a lot of ETFs do pay some kind of dividends. That's just my particular strategy, is I like stocks or ETFs that pay off dividends. But I think a good example for this is the example on the right. So if you believe cybersecurity is a smart investment, but don't know which single cybersecurity company to invest in, you may not have to pick one. Instead, a cybersecurity ETF could include shares from a variety of cybersecurity companies, giving you a wider range of investments in the cybersecurity diversity or cybersecurity industry. So, takeaway, it is similar to a smoothie. It's one thing you can invest in that's made up of a mix of ingredients. ETFs are available in different asset flavors. They may track different industry sectors or types of companies. You may have heard before, it is good to have a diverse portfolio of investments, so that basically you're not gaining or losing everything all at once. And ETFs basically are one thing you can invest in that is already in itself diversified. So those are usually, in my opinion, pretty good investments. Now, when using the Robinhood app to actually know when to invest or just get updates about stocks, it's good to make different series of stocks in order to receive updates. So there's this whole feature on Robinhood where you can add basically stocks and save for later or like track basically. And when you do that, the Robinhood app actually pulls up articles and notifications for you like, hey, and you can see in the image beyond, Mead has this update or this partnership or loss of this partnership. Something like that that could influence its increase or decrease in stock price. And then also on a daily basis, Robinhood will also say, hey, this stock went down a bunch for a certain percentage, hey, this stock went up a certain percentage. And basically having your stocks basically saved for later to look at tells Robinhood what you're interested in and then notifies you, and you of course can adjust the notifications, but notifies you when significant changes in those stocks happen. Also, I should say that if you don't want to spend a bunch of time trying to save all these stocks for later yourself, I have put in the description all of the stocks that I have personally saved. You can use them if you want to, save them if you want to, but I just put that there to make things easier if you do want to save some of those. Thank you for watching. Please share and subscribe, and remember to spread